Balance your trading strategy by adding futures. CME Group helps you manage risk and capture opportunities in all market environments. Capitalize on around-the-clock access to highly liquid global futures and options market across all major asset classes. Just visit your online broker and get started. Plug into valuable educational materials and trading tools and see what adding futures can do for you at cmegroup.com/on-the-tape.
Dan here. Welcome to the podcast version of Trading Spaces. Every Monday and Wednesday at 1 p.m. Eastern, Guy Adami and I host a live Q&A on Twitter Spaces. We talk about everything from tech to crypto, rates to commodities, and have some pretty cool guests drop by. So check us out every Monday and Wednesday at Trading Spaces on Twitter and hit follow in the podcast store. So if you miss us live, you can listen to us later. And if you like what you hear, check out our podcast On the Tape that drops every Friday morning with our co-host, Danny Moses. It's 1 o'clock. It's a Wednesday, and every Monday and Wednesday, Guy and I do Trading Spacers. They're sponsored by CME Group. CME Group is the sponsor of the podcast On the Tape that we do with our good friend, Danny Moses. He is our co-host here. So we do these just to talk markets as the markets are live and what's going on. And every once in a while, we're bringing a special guest like Brady Cobb, who's going to come on in a little bit after we talk about markets here. Danny, really important day here, which is why we wanted you to join us on Trading Spaces here on Twitter Spaces. Guys, let's get into it. Guy, what's your take here? Because you and I have been talking markets the last few days on our market call, which you and I do Monday, Tuesdays, and Thursdays live at 11. You can follow that on our Twitters. But this is kind of interesting. Big reversal day. You have the things that we thought last night when we were on Fast Money. We were talking about Alphabet's earnings. We were talking about AMD's earnings. They're screaming. And then the PayPal, though, interestingly, gets worse. Okay. At the time, we were talking about that down 15%. It's now down 26%. And we have a very, very bifurcated market. I think it's a really important day. That's why we wanted Danny to make sure he got his tail over here to talk with us. But, Guy, what's your take right here?
And may I say, for the record, it is a good-looking tail. Well, at around 11:15 today, I don't know what was going on, but, the NASDAQ briefly went negative. S&P went flat. Dow traded probably unchanged to slightly lower. And to your point, although things look great and those Google earnings were outstanding, and then you can say the same about subsequently AMD, Microsoft, and Apple, there's some things under the surface that once again do not look particularly strong. So I am going to be fiercely watching. That's a one of those adjectives that the former president used to use. How this thing closes today, because I think it's going to be a huge tell. And if you get any weakness whatsoever out of Facebook, and again, I don't know who she is, but Katie barred the door.
Well, Danny, so this is one thing you and I were talking about kind of earlier is that, the names like Alphabet, okay, and Microsoft and Apple, the ones that were kind of, these are the biggest names in the market, and they were like really masquerading some very, very bad performance in the market for the last 6 to 9 months in dozens, if not hundreds of stocks in the market. And here we are. We had that really sharp decline. The S&P 500 was down a little more than 10%. The NASDAQ from its highs in November is down 18%. This is at the lows last week. And then we had Microsoft and Apple earnings and guidance, which really seemed to put a floor on things. I think last night, Alphabet, people were feeling pretty good. But the question I have is that, are we in for more of the same where those names can kind of keep things, afloat, but there's continued devastation below? And what's happening now, it's kind of migrating, if you think about PayPal was a $300 billion market cap stock, 6 months ago, and now it's south of 200, losing 25% in one day. Are we seeing this virus spread?
Yeah, I think the money's hiding in fewer and fewer places. And we knew those numbers would be good. I mean, those were great quarters, obviously, out of Google. And so money's flocking there. But, we had, I would call a bear market rally. It was the end of the month. I mean, obviously, the market can't go down every day. So we had people kind of buy the dip until it doesn't work. But I'm looking at taking a step back and looking at the broader picture here. And that is the fact that we got through the Fed meeting. They're going to hike in March. They're pretty much done with tapering, right? So that's going to be ending. That's kind of set in stone. And now, if we start to see economic numbers, the Atlanta Fed came out, and they're wrong a lot, but Atlanta Fed is lowering their expectations for GDP. You saw jobless claims. Yes, it's probably affected by Omicron, or the ADP number, I should say, affected by Omicron. We're going to get the jobs number Friday. We just crossed the national debt at 30 trillion. By the way, we just increased the debt ceiling from 28.9 trillion to 31.4 trillion, right? We're already halfway there. Granted, they'll probably raise that again. But what's really interesting is I think when we look past kind of the earnings season here and an excuse to kind of buy certain names, certainly it's still evident that if you miss, you get killed, right? If you miss a number right now, you're probably going to get oversold and drilled here. So I think this is a sell into strength. Don't kid yourself. If you own a crappy name and you're getting a lift here, I would use the opportunity that you promised yourself 2 weeks ago. You said, I swear, if it gets to X level, I'm going to sell. Well, if it's at that level, you should probably be, selling it. So I'm preparing for a very tumultuous February and March, I think, as we, kind of get into the season here. So now that we're kind of getting through, we're more than obviously, I think, halfway through earnings, maybe, Dan, at this point, or close there. So I'm not bullish at all on this market action. So.
Well, Guy, on Monday night's Fast Money, Tom Lee of Fundstrat and FS Insight, he had called, I guess, at the end of last year for some choppiness in the beginning of the year. He expects obviously much higher levels by year end, but he came on the show on Monday and said to the audience that he expects a violent V reversal here. And we did, listen, it looked a little bit more like a W. It was a bit of a chop last week, right? But then we broke that downtrend that had been in place for a few weeks here. What's your take on bear market rallies? Danny and Guy and Dan, we're old people here. Maybe there's some younger people here and have not experienced a protracted bear market rally. But is that what we're in, Guy? Is that what we just had?
And the counter trend rallies in markets that are now maybe turning the other way are the most violent ones you'll see in equities and commodities and, quite frankly, in currencies as well. And we've seen that a number of times. Go back a couple Mondays ago when the Dow was down over 1,000 points and look at that bear market rally. Now, again, there's a lot of chop here, and some of the most difficult markets to trade are these markets because everybody's convinced they finally bought the bottom, and then they just it's what we call getting chopped up. And I think that's what's happening here. And I'll stand by it. I mean, I think the top's been put in for quite some time. I hear what Tom Lee is saying about this violent thing, but I also think that we're underestimating some of the things that might take place post-Olympics in the form of China, Taiwan, and this continued problem with Russia and Ukraine. I don't think the market is taking that into consideration whatsoever.
I totally agree with that. And look, I'm now of the firm belief, and I've been saying this for a while, that if you told me that the 10 years at 1.5%, I'm going to tell you that the S&P is probably around 4,000 at this point. So careful what you wish for. Everyone, again, is looking for rates to subside and, specifically the 10-year yield to give them the buy signal. My feeling on this all along, and anyone that's been listening to us knows this, that you actually want 2%. You want 210, 220. Now, that comes with consequences on the other end, but that tells me you're in a healthier environment. And what I'm seeing right now, the 210 at 60 basis points, I think it keeps shrinking. Like I said, I think Fed's going to go. And this interesting article today on Bloomberg, let me just put this in perspective for what we're really looking at here on the national debt level. And I'm sorry to keep harping on this, but as we cross 30 trillion, it's a little mind-boggling. So if in 2001, the average interest that we paid on our debt on the federal level was 5.4%. Today, it's 1.5%, right? We paid $562 billion last year just on interest on the national debt. That's like 22%, I think, of what we pay in income tax to the government. Can you imagine what this is about to look like? So what level can the 10-year yields, the average duration on U.S. government debt's about 5 to 6 years right now, so it's shorter than it used to be. But just look at the 5-year yield. What level can we really sustain where we're paying north of 50, 60%, right, of our income tax going towards paying the national debt? It really becomes an issue. And I go back to that's why we can't have high rates, unfortunately. Meanwhile, in Germany, the 10-year yield, granted, is now in positive territory. Yes, it's 4 basis points, everybody, 4. But look where it's come from. They have a little bit of runaway inflation going on there, too. They're going to be so hopefully everybody's raising rates so that the dollar doesn't smash records and move that much higher, because that's what will happen if we're the only game in town doing it.
It's interesting, Danny. I'm with you. You know that. And I know what you're saying, that, if rates go higher, it's going to be catastrophic. But just because we're screwed doesn't mean rates can't go higher. Now, they'll do what they can to keep them, at bay. But that genie's out of the bottle, in my opinion. And I've been saying for a while now, and I know you know this, I think the 2s, 10s are going to 30 basis points, and I think they're getting there in the form of 1.5 in the 2 and 180 in the 10. And that's not that far away. And so we'll see what happens if and when we get there. So
I guess what I'm saying is this is my belief that the Fed unwinding its balance sheet, I don't think really does happen. And the Fed statement that they'll let mortgage-backed securities kind of roll off, before they will treasuries. I would agree with that because what they don't want to do, to your point, Guy, is signal that they really don't have much control over anything these days, but that they truly lose control, because that is the ultimate washout, right? If the people feel like the Fed has lost control of the markets, which may happen inevitably, but again.
So Danny,
and real quick, Dan, I got to interview Novogratz last week in Florida, and we talked about a lot of these things we're talking about now. And one of the points he's made, again, things that we've talked about, debt to GDP in this country is about 130%, which is just mind-boggling if you think about how just totally screwed we've gotten ourselves. And it's collective fault. I get it. But, one of the things he said is there's no developed economy that's really ever come back from that. And that's really scary shit. So they've dug a huge hole.
So buy Bitcoin, Guy?
No, listen, is it Bitcoin? I don't
No,
know.
I know. It's really funny though. I think that some of these macro guys, and I'm not, again, Novogratz is a legend, I guess, right? And it just seems like a lot of these narratives are very they're very convenient for this kind of Bitcoin thing. And I will tell you, I think if Bitcoin were to go lower, and we'll talk about that after, it might just like invalidate so many of these kind of macro arguments that are going on. I'll just say this, Danny, about your call on the 10-year. Amanda has a chart right here, this thing. I mean, you look at this thing, it looked like it wanted to break out. It spent a little time above that kind of 1.75 level. It got above 1.85 or something like that. You do the uptrend from the summer lows of last year. You look at that 200-day moving average. I mean, this thing's got 1.5 written all over it. So I guess the question is, what scenario? We have this jobs number coming out Friday morning, okay? And I saw a headline that the White House is already bracing for a weak January jobs number. Let me ask you this. Is the 10-year telling us that inflation expectations are basically, the highest ones are in the rearview mirror here? And then what does that do to this narrative? Because that's what the 10-year, the weakness in the 10-year is kind of telling me a little bit. Just that inflation, the heights and the fears of 40-year high CPIs is basically behind us.
I think that I do think there is supply chain shock, which is causing certainly certain things to probably be extended slightly higher than they would have gone, and that is having an impact on the consumer. You're seeing it. You're seeing it in consumer confidence expectations on what they're spending money on services instead of goods. So that if they stop spending, by definition, it's self-fulfilling that things will slow down. But Dan, I do believe, like I said before, that I don't think that the 10-year selling. I think the 10-year yield is potentially telling us, if it goes to 1.5, that the market is going to slow, not just as a result of inflation, but the Fed raising rates. And again, that's why I think they're kind of 3 and done. We can talk about that on our normal podcast, but we're kind of saying the same thing here. But I just think this
should we save that for the podcast that we're going to tape tomorrow afternoon? It's called On the Tape. All right, let me ask you this though. Why do you think we are seeing the reversal in some of these high valuation tech names that we just thought were dead? You remember the Niedermeyer stocks?
Yeah.
They're absolutely getting destroyed today. So anything that has, Guy and I did, we launched another, for you guys listening here, we launched another podcast on technology called OK Computer. It drops Wednesday mornings. Go check that out in the podcast store. People follow it, rate it, review it, share it. That's how people find it. But we had a conversation with Rick Heitzman. He is a tech investor, VC at FirstMark. Guy jumped on yesterday afternoon, and we were talking about, listen, some of these, valuations that were trading these SaaS names 20, 30, 40 times, sales, okay, have absolutely gotten destroyed, down 40, 50, some 60, some percent or so. But some of these things still have really fat price to sales. One of them, okay, is Snowflake, which is down 5% today. $80+ billion market cap company, only expected to do $2 billion in sales. Danny, you can do that math here. There's still a lot of stuff that is supremely out of whack here, no matter what rates do. So I'm just curious, is this going to be the thing? If the good news by the mega caps, the MAGA names, okay, is behind us now, we all know that. Like you said, we expected them to have good quarters. If they didn't, they're going to be dead. And now, are we in the hands of those who are just worried about, obscene valuations?
I think that's just the risk on, risk off, day to day jump around, right? Everyone knows. I mean, the terminal value on these companies, or not just say terminal, but what people are looking at over the next kind of 6 to 12 months is certainly lower from here if you're doing any fundamental analysis. And the cream is rising to the top. And I kind of said when we started this today that I think, the leaders, the top 5 names in NASDAQ that continue to kind of carry the day, right, are carrying the day even more so, I think, going forward. And if you lose one of those, and we've attempted to lose kind of some of those key names over the last kind of 4 to 6 weeks during this volatility, it's becoming more and more pronounced. And so that's more and more dangerous as far as I'm concerned, because how many places can you go hide in at these valuations? So long-winded answer to your question is, Dan, I wouldn't own any of these things that trade on multiples of sales. They either don't make money or make little money. And again, if I'm these companies, I'm issuing shares as far as the eyes can see up at these prices if I do need cash and live to fight another day. So
it's funny that you mentioned that. We just really haven't seen too much cash raising. We definitely saw a bunch of insiders selling into the end of last year. Guy, what about energy? This is an area that's obviously massively outperformed this year. You've been all over that. You've been all over the crude breakout, the OIH, the oil services names, and the move in Exxon, the largest integrated name. That's out of control. I'm just curious if we were to see economic activity slow down, which is what I think we're all in agreement is what the 10-year is kind of telling us. Isn't there a scenario where crude oil comes in?
Yeah, listen, you've said this for a while, and if you look at where Exxon is now, this is where we broke down from 3 years ago, March of 2019. So this is a logical level to stop. And yes, if economic activity goes down, that will be a headwind. But so much of this CapEx, so much exploration has been stopped that, it's there's a supply demand dynamic going on here that takes a long time to resolve itself. And I've said this, I'm not the only one that said it. A lot of people say it. The cure for higher prices in commodities are higher prices. And I think that's we're in the midst of now. So the OIH, which has made a bottom a couple times around 175, we've talked about it. It's been in this sort of 175, 230 range. We're at the upper end of that range now. I happen to think it's going to continue to grind higher. I can understand why some would be inclined to take money off the table if you've enjoyed the run. But, I don't think this crude story is over by any stretch. And the OPEC Plus meetings and all this shit. Listen, the only thing that derailed the energy trade in November was Omicron Friday after Thanksgiving, and then the subsequent, or if I don't know if it was before or after, it doesn't matter, but the SPR release, which was a joke. So, we should be here, and I think we're going higher.
Yeah,
and by the way, that's not a political thing. I could give a shit about
of course.
politics.
But here's one of the things Guy would just say about the crude oil chart. If you look at it from the bottom left a year ago to the upper right where it is right now, look at how the volatility bands have been widening a little bit. The peak to trough declines from highs have been getting bigger and bigger, and there's been 3 big ones. The last one, being north of 25%. So I think that's something worth keeping an eye on, because the next one might be pretty dramatic if there's any reason for it to come in hard. Danny, here's one near and dear to your heart. What about home builders? We've seen as the 2-year went higher, we haven't seen again the commensurate. I mean, we have seen the 30-year mortgage rate hit multi-year highs, I guess, right? Home builders were trading at the start of this year very near all-time highs. You've seen this pretty sharp, at least as the XHB is concerned, 86 down to 70. Now we had this bounce up to 75. Thoughts on that group, and then also banks in general, because all of those earnings are out. I'm just curious what you think here with rate environment.
Yeah. I want to make one quick comment on Guy's point. So the person I want to be right now is the portfolio manager in Boston, whose benchmark is the S&P 500, who walked in January 1st and said, I'm going to underweight technology and I'm going to overweight energy, because their year's done. They've already made their year. Now they can just go benchmark the S&P 500 from here, call it a day. So anyway, I wanted to comment on that. But as it relates to the builders,
I mean, then you pull a Dean Smith, man. Then you just go 4 corners.
4 corners, exactly. You go 4 corners from there. And people out there that know that's how a lot of these portfolio managers get paid on the long only side. As it relates to builders, I mean, pretty much they track the 10-year yields, right? Or wherever the mortgage rates kind of go. And mortgage rates have been rising, as we know, because a lot of the mortgages originator kind of toward the short end of the curve. And so you're having a little bit of an impact there. I mean, how much longer can you have the move out of the city? So there is a macro part. There's a secular part to the builder play. I get it. But I think the builder's ability to pass on their increased costs of lumber, et cetera, and it trades on that too. It trades down on commodities, up and down on commodities as well. I'm not a fan of the builder sector here. I wouldn't short it because I do think there is a secular move there. As it relates to the banks per se, I mean, listen, they had great quarters. Again, if the market stays like this and volatile, I'll say it again, the IPO calendar dwindles a little bit. That's a huge source of revenue for these banks, right? Some are more tilted towards investment banking, some towards the consumer. I think we've seen the peak in consumer credit. I don't think it can get any better, can potentially get worse. So that tailwind, is now gone. And the cost, these bonuses that are getting paid now to maintain and keep these bankers from moving around Wall Street, which for the first time in a long time, there's a bidding war, right, for analysts and bankers. That hasn't happened in several years. And we're back to kind of 2007, 2008 bonuses for some of the CEOs. So a lot of those fixed comp things, those don't change quickly. So again, on the margin, I'd be watching, growth in consumer credit. I'd be seeing if the market stabilizes and get the IPO counter back. But these are utilities, and you can own them. The balance sheets are safe, but they're not sexy. And energy right now is sexy. So,
Anyway.
Hey, before we bring Brady Cobb in, I want to ask both of you guys this, and Guy, I want to hear you first here a little bit. We've seen some fairly dramatic moves from some very widely held stocks. And, I go back to the year 2000 when, it seemed like the whole market was made up of meme stocks back then, if you think about it in the late 90s and the early 2000s. But there was a couple huge blow-ups that after the fact, once we knew the market basically had crashed and we were in a bear market, you could have gone back in 6 months and, 6 months out and said, okay, that was it. We should have known, right, when those numbers. And so there's a couple instances last year in the summer, Guy, when we had this huge gap lower in PayPal, in Amazon, right, on their Q2 results and their Q3 earnings. And then when we got to Q3 earnings, Snapchat sold off 25%, right, in one fell swoop. And then this year, just this quarter so far, we saw Netflix down 25% after their earnings. We're seeing PayPal down 26% in one fell swoop. Guys, are we on the precipice of something? And I'm not trying to freak anybody out here, but when you have those sorts of stories get marked down like that, and then you look at the devastation that's gone on in names like Zoom, and the list goes on and on and on. Are we on the precipice of something bigger here? Are we whistling past the graveyard?
Everything you say is accurate. I've thought that for a while, incorrectly, by the way. When the basically the structure that's been built, this high-rise apartment building that gets higher each day, is built effectively on 3 or 4 different names that are carrying all the load, and then you start to chip away one by one. It's just a matter of time before some storm comes along and knocks the whole effing thing down. It hasn't happened. So these warriors, these generals, whatever you want to call these names, continue to perform. By the way, understandably so. In this environment, the rich get richer, and that's what we're seeing with these big name stocks. But it's just a matter of time, in my opinion, before everything you just talked about comes home to roost in the form of the broader market.
Yeah, I echo those comments. And I also would just say, Brady's finally here. I also just say that when I think the market's going to be rational, you see news like AMC come out. The reason they put out those numbers for Q4 was so that they could issue new debt, right? So they're just trying to kick the can down the road, which they should be doing to lower their interest. But stock trades up 15% on that, right? Pulls in. This is a company with $5.5 billion in debt. You know who I want to own for Spider-Man? Sony Pictures. They had a good quarter. They have a good balance sheet, and they get the benefit of Spider-Man. So as long as I keep seeing things like that, I know we're not near the bottom, Dan. So that's kind of how I look at it. But we got Brady on here, and if you want me to kind of set the stage
intro
here.
Brady, yeah. Tell everyone who he is. Just so you know, Brady, Danny Brady and I had dinner in Miami a couple weeks ago at Coat, and I'm going to Coat, New York tonight, gentlemen. So I know you're just kind of licking your lips a little bit here.
Well, I'm glad I didn't have to pay for the one in Miami. So Dan, thanks again for that. But,
well, listen, I'm down 10 dimes to you. What do you now? What is your record in the NFL, Danny? Now is it 29-5 or something?
No, I lost the game and pushed one. But anyway, let's get to this stuff because this is better.
Introduce
anyway, so
Brady.
Yeah, so Brady Cobb needs no introduction, but I'll just introduce him. He's been around the cannabis sector for a decade now, more than that, obviously, if you include when he wasn't doing it legally. Came from a great background that led him to this point. His father was involved in the cannabis industry when it was frowned upon in the 70s, and that kind of led him to become a lawyer and vindicate everything that his father stood for. But in doing that, he built 2 companies. One he just sold to Cresco Labs last year, Bluma Wellness down in Florida for over $200 million. He's looking to do something like that again. But more importantly, he's an advocate for the industry. and he's in Washington a lot. And there's been a lot of developments, over the last 6 months, people paying attention, and he can talk about that. There's an update there. And then also I want to get Brady's thoughts on, we saw some mergers, M&A activity in the space just yesterday. Verano acquiring what was formerly known as Vireo, Goodness Health. I think we're just going to start to see more of that too. So Brady, without further introduction, love to hear your thoughts on kind of that stuff. So.
Yeah, no, thanks, Danny. And Dan, Nathan, great dinner, by the way. NFL picks, I don't know where you guys are at on the Super Bowl, but whenever that bet gets paid, count me in. I want to be there for dinner. I think we should have Guy along too. I don't think it was right just to call in with him.
I agree. Thank you, Brady Cobb. By the way, those that don't know, Brady's another just sexy man. Anyway, back to you.
I appreciate that. So here's where we're at. I mean, look, Safe Banking Act. I came on this show a few times, both the podcast and this Trading Spaces, back in the fall when Safe was making its 5th attempt at getting passed as part of this NDAA, the National Defense Authorization Act. Senator Schumer obviously took the air out of that balloon and did not let the bill go through. But if you remember, there was a House Rules Committee where Representative Perlmutter, who's the champion of the bill, ultimately was going to try to reintroduce it and was told to stand down by leadership at Schumer's request. And then he vowed in the hearing and immediately thereafter that he was going to take every step possible up and through his announced retirement at the end of this congressional session at the end of this year to get it passed. Well, he's a man of his word. He had it added on via the Rules Committee to the America Competes Act, which is another must pass. It was deemed to be in order by the Rules Committee yesterday. It will go to a House floor vote where it's expected to pass and become a part of the bill. There's a Senate version of the bill as well, where we'll set up this same discussion on whether Senate leadership, Majority Leader Schumer, will ultimately block it. There's a couple of interesting things in play. One of the things I think everyone's kind of picked up on the fact that Senator Schumer largely deferred to Senator Booker, and Senator Booker is an outspoken advocate for social equity in the cannabis space, which I wholeheartedly agree with. But, they're also needing and staring at the fact that they need to get a win here relatively soon before they head into what's going to be a lame duck session as they tee up these going to be very volatile midterms. So Safe is there again. It presents another opportunity to potentially get passed. I can tell you, without going into too much detail, I've been working with the NCR and Weldon Angeles and others on a myriad of options for social equity that do not require congressional action. You're not going to reveal the details of those yet, but we've been active at work, including being on the phone with Senator Booker's team the day after Safe Banking failed. And Danny, I know you've weighed in on your thoughts, but in my mind, Safe Banking ultimately does pass, and there's been lots of folks talking about that they believe that it will, both industry insiders like me, as well as legislators. That passes, that kind of opens up that wall of capital in the U.S. that's been on the sidelines from a custodial standpoint and or from a compliance standpoint, because it'll provide the safe harbor necessary to avoid the anti-money laundering. It's a big re-rate opportunity. And then it's a stepping stone to potential U.S. uplistings. You're also going to see, I believe, the introduction of the MORE Act in the Senate, which it has, that it's only been a House bill thus far. So I think over the next, call it between now and Memorial Day weekend, you're going to see a period of activity across all legislative matters, because it's largely been a do-nothing Congress thus far, but they got to get some wins in the books before they head off to campaign for the midterms. So it's kind of that moment to strap the chin straps on, put your helmet on, and it's go time to kind of see, across a myriad of things. BBB, it was, Manchin weighed in yesterday that's not coming back, but there's a bunch of legislative priorities at the president's desk, cannabis and otherwise, that are going to get pushed here as we head into an increased period of legislative activity ahead of what will be a big campaign couple of months ahead of the midterm. So, Danny, I don't know how you see it, but I think everyone needs to pay attention, not just to cannabis, but broader market issues that bills could affect, because it's going to be a busy time.
Yeah, there's a wall of money waiting. And as a matter of fact, while we're waiting, you're now seeing debt at 8%, 9% coming to some of these big multi-state operators. And so they're not waiting. And that's down from, let's call it 11, 12% a year ago. So you're already, and that's with a rising rate environment, if you want to call it that. So there's more money coming off the sidelines, but there's more money looking for a true excuse and protection from the government to come off the sidelines. And when that does happen, I think we're off to the races. And what's happening now is, I think we're going on this next iteration of M&A activity where companies that have a solid balance sheet able to raise the money can start to buy some of these smaller companies, which may not have the growth capital that they need, but have an incredible footprint. So we've become asset plays to some of these, and we saw one of them happen yesterday, and I fully expect there to be several more. And Brady, just if you want to talk about that for a second, I think you'll start to see, and it's much more discerning now. It's like people want New York, people want Florida, people want, states that they want comfort in, right? Where they're not just going in and spending recklessly. So I think we're going to keep seeing that as well.
Yeah, I mean, you saw the Verano deal, and it's on my Twitter feed. I'm a huge fan of Verano. They're one of the best, in my opinion, the best operator in the space. Look at their EBITDA margins compared to everybody else. A lot of people post a big top line number. George Archos, Sammy Dorf, they know how to run a really good business, and they're building a monster. And for them to pick off New York, pick off one of two in Minnesota, Maryland, add to their Pennsylvania portfolio, and what I think was a very good price tag. I think it's just a signal you're going to see a lot more of that from an M&A perspective as the industry consolidates. There's a lot of tier 3s and tier 2s out there, operators that, these tier 1s have lowered their cost of capital to such a level that they can go and utilize their currency, their paper currency, to go and add and kind of set themselves up before we look at a potential federal catalyst. And I think you're going to see that continue. And I think once that federal wall comes down, you'll see it not just happening from the cannabis industry, but you're going to start seeing some of the alcohol, tobacco companies. Initially, will be the first two over the wall, in my opinion, that'll start looking at making bids in this space. You can't deny the size of the market, how it's growing, both from an incremental standpoint of new patients coming on board, anecdotally and or via the research. But you're going to see, this is a CPG category that no matter what their stock price is, and Danny, you and I were talking about it this morning. I mean, you look at some of these companies, they're not even trading at 2 to 3 times their EBITDA. It's absolutely crazy. And these are businesses that are generating EBITDA while they have a draconian 62 to 63% effective tax rate between federal and state because of 280E. So as you see this federal law potentially shift a little bit, these businesses, the ones that are cashed up with good cost of capital, I think you're going to see the M&A activity from a strategic standpoint start to kick up a little bit too.
Awesome, Brady. I don't know if Dan and Guy have any follow-up. I know Guy's really into the sector. So, Guy,
I've never puffed the magic dragon, nor will I ever, but it does not mean I frown upon the
But that's
We're
the
converting
good
you. We're converting you.
But Brady, isn't that the good news, that he doesn't have to puff anything? You just kind of partake, and there's a lot of things. Guy, when you think about some of the things that ail you physically, there's got to be some sort of combination between CBD and THC that would just really kind of take some of those edges off. Maybe we'll just leave it at that. Well, listen, Brady, you and Danny, the two of you guys should have a podcast together and just cover this stuff on a weekly basis. Wouldn't that make some sense, Guy?
Yeah, it's in motion. We always want to start it and then something happens. But yes, we will definitely be doing that.
So. Well, listen, Brady, you're the man. You showed great hospitality when I found my way into Fort Lauderdale down there to see you and Danny, and we had a great night out in Miami. So we really appreciate your insights here on Trading Spaces. And you can always come back here, man. We'd love to hear what you got to say, and we're tracking your space. And I know a lot of our listeners really care about it too. So thank you, Danny. Thanks for this emergency Trading Spaces with what we think is an important day in the market, despite the major indices being green. Guy and I want to thank you for joining us on Trading Spaces. If you came in late, we will put this in our podcast feed, so check it out, people. Check us out on the tape this week, also sponsored by CME Group. We're going to have Jeff Richards of GGV Capital. He is an excellent technology investor in the private markets, and he's going to help us think a little bit about some of these public market valuations that we were just talking about, and some of these SaaS names. And then Danny has a whole laundry list of stuff that he did not get to today that we're going to talk about. So that drops Friday morning in the podcast store. So thanks everybody for joining us. Thanks, Brady. Thanks, Danny and Guy. I'll see you a bit later. Thanks, guys. Thanks for listening to this episode of Trading Spaces, brought to you by CME Group. If you like what you heard, follow us on Twitter @Trading Spaces and join us live every Monday and Wednesday at 1 p.m. Eastern.